You see how there's two fair value gaps here on the 3 minute inverses?
Yeah.
Okay. I did not enter on this one right here. Why did I not enter on this candle right here? Can anybody tell me?
The rejection of the FEG above,
The rejection of the FEG.
the
No,
the
I did not buy on the close of this candle, which inversed this 3 minute fair value gap. Why did I not buy this on the close of this candle?
Inside the order block?
Nope.
oh, the break-even point.
Yep. It already took out this little internal liquidity level and it rejected from it. That's a red flag. But then the next one easily broke above. And then I just bought the order block right here. This was my entry right here, not down here.
Oh,
Does everybody understand that? Now, this is not necessarily an internal high, but it is the order block. And since we didn't close above the order block and we crossed above and rejected, this is just a little bit of a red flag. You want to see momentum. You don't want to see rejection. You don't want to see price cross that internal high and reject. But the next candle was very strong and then closed above the 15-minute order block.
And then you bought the retracement, that black candle. Did you?
I didn't even buy the order block. As soon as this closed, I waited a couple of seconds just to see if we got a pull in, and I entered like right in the middle right here. Just a little off the side. Not necessarily. I didn't wait for the order block. As soon as this closed, okay, I saw us pulling in a little bit, and as soon as I saw this pulling in, I just market ordered right here. It didn't matter to me anymore because now we have this fair value gap. Now I can have my stops here, right below this candle. It doesn't need to be below this fair value gap. It needs to be below this inverse fair value gap.
Nice.
Yeah, and that way the move up to London was about 5 to 1, 6 to 1, 5.5 to 1. So here's the deal with this. Okay, we're talking about a couple different ways to enter. Okay, but let's put this into perspective. Whether you entered on the 3 minute fair value gap, whether you entered on the order block, whether you entered on the CASD, or whether you traded the ES, right? Doesn't matter. They all worked out, didn't they? Right? And why is that? Because you are trading from a key level. And when you're trading from a key level with SMT and a failed auction, your entries don't have to be perfect because you're trading from a great level. I'd rather have a so-so entry at a great level than a great entry at a so-so level. Does that make sense? So if you concentrate on trading from good key levels, whatever you do on your entries, if you make a mistake, you're still going to work out fine because you're trading from an important key level. It's when we start not trading from important key levels that we start losing. And Gerbelter, this is a perfect example of what we talked about, looking to get those equal highs. The setup that you had might have been a good setup, but you're not trading from a good key level. So you had a good setup, but it's not at a key level. But if you're trading from key levels and you're trading from the right spots and you make a mistake or you're a little late on your entry, you're still going to be rewarded because you're trading from the correct area, right? If I'm going from point A to point B, okay, and I make as long as I'm leaving from the right place and as long as I'm heading in the right direction, it doesn't really matter if when I pull out of my driveway, if I accidentally make a right or a left. I may have to just go around once, but I'm okay because I'm still leaving from the correct area. So if you're delivering and trading from key areas and correct areas and the right areas, and you have the right draws on liquidity, you're going to be rewarded no matter what you do. And coming in this morning, if you're marking up your charts properly, okay, you have to have this drawn out. When you have this drawn out, these liquidity, the market, this is not an accident that these are perfect. It's not an accident. It's engineered liquidity. We see it all the time. And when we see it, and then when we see ourselves hit a key level, we know this is going to be a great draw on liquidity. I see this trade 100 times a month. Always see this trade. Trend line, trend line, trend line, manipulation down, hit a key level, inverse fair value gap, trade through that level, the London highs. Now, let's say you just followed the rules this morning and you didn't take into account anything we talked about, the 4-hour, the 15-minute. You're delivering from a same time frame fair value gap. You took out a key level of liquidity. You had an inverse fair value gap. And if you went long on the inverse right here, even though it hit and rejected from that internal, you still made money. Why? Because you traded from the right spot. So you made money whether you took this, whether you took this, whether you bought the order block, whether you bought the change of state of delivery. You made money because you are trading from the correct level and you're trading towards the correct draw on liquidity. And if you concentrate on doing that, any entry you do will be forgiven. On most days, this shouldn't even be an issue because our entry model is pretty clear. There's no subjectiveness to it, all right? And even if you bought the close of this fair value gap, yeah, it came in a little bit, you still made money. Why? Because you took liquidity and you're coming from the right spot and you're trading towards the correct area of the draw on liquidity. And we can't draw to an opposite end liquidity until we take the first end. It's an auction. We need to see if there's sellers. In order for us to see if there's buyers, we need to make sure there are no sellers. And the way we make sure there's no sellers is we go to the lowest bid. Just like if we were auctioning off a piece of art, the only way that we will find out if someone is going to bid higher than $100,000 on this painting is to ask and go higher and ask if anybody's willing to pay $101,000. If we get to that level, you may hear 101, 102, 103, 105, 110, and that means price is being accepted and we'll see a continuation lower. But if we get to that level and we hear crickets, or in this case, we have buyers coming in, not sellers, then we know this is a failed auction to the downside. And what happens to a failed auction to the downside? We then have to go price discover the upside. We're not taking stops here. It's an auction. And in order to go higher, we need to make sure we can't go lower first. And that's why we have a lot of these moves sometimes where you'll go lower, and any manipulation move in an AMD is always making sure that we flush out all the sellers and make sure there's no sellers below until we go higher. And that's the concept of an AMD. You have accumulation, okay? And if the market wants to go higher, okay, the market makers are saying, okay, I don't know where we're going here because everybody thinks there's a fair price here. Okay, so what do I need to do? I need to price discover. So I'm going to go down here. I'm going to take the market down here. See if they attract sellers. If it attracts sellers, then I know that the market is accepting lower prices, and then we'll keep bidding lower until the market goes back into balance. Or what will happen here is you'll go down here, you will attract no sellers, and you attract buyers. And all of a sudden you get that. And that's how we get an AMD. That's the philosophy of an AMD. We're not grabbing stops. We're grabbing some stops. We're inducing some, but it's price discovery more than anything. Remember, we always talk about the retail traders, the stops on the retail traders. It's BS. The retail market only encompasses maybe 5% of the volume. Okay, and nowadays, so many retail traders are trading prop accounts. Those are even simulation. They're not even on the live order books. But if you take a volume profile, all the volume's in the middle. It's not at London highs. There's no volume here. And down here, where's the volume with all the stops that were taken? Where's the volume? There wasn't any. Because when price came down here, there was no sellers and only buyers, and that's why the price moves up quickly to the other side, because there are no sellers below there. And what can't go down must go up. What can't go up must come back down in an auction.
Hey everyone, it's Dale here. I hope you enjoyed the video. If you like to trade alongside me and our team of prop firm funded traders every day, then click the link below the video and hop aboard. We are looking forward to trading with you.